Hey, what's up, everybody? Tim Albrecht here, and welcome to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist Podcast, where we feature questions from you, the YFP community, to be answered by one of YFP Planning's fee-only certified financial planners. Before we jump into today's question, I want to give a shout out to YFP Planning's incredible team that makes this segment possible. YFP Planning offers fee-only comprehensive financial planning services that are customized to the pharmacy professional. So whether you want to optimize your investing plan, pay off student loans, or simply build a solid financial plan, YFP Planning will help get your income working for you rather than the other way around. You can learn more by visiting yfpplanning.com. Again, that's yfpplanning.com. Okay, this week's question comes from Tyler in Iowa City, Iowa.
Hi, this is Tyler Wempen from Iowa City, Iowa, and I was wondering about how many investment options should someone have in their portfolio? Should you focus on a few or diversify with all the options?
Thank you, Tyler, for submitting your question to be featured on this week's Ask a YFP CFP segment of the Your Financial Pharmacist Podcast. Tim Baker, what are your thoughts?
This is a great question, Tim. And I kind of like transport myself back to like when I first started investing in my own IRA or in my first 401k. And, you know, the options there were plentiful. And I'm like, okay, I'm going to do a little bit of here and a little bit there. So I was like, you know, kind of diversifying and not putting all my eggs in one basket. And some of that can hold true, but I think there's an argument to be made that, you know, less is more.
Mm-hmm.
You know, I think you can slice this a number of different ways. And again, this is not investment advice at all, but kind of some general rules of thumb. So when we work with clients on their investment portfolios, I think the biggest question that we have to ask is like, you know, what is the risk appetite and the appropriate asset allocation that goes along with that? So what we're really trying to determine is like how much of the portfolio should be invested in equities or stocks, and then the rest, how much should be invested in bonds or, you know, fixed income.
Mm-hmm.
So that's the overarching question. And if you answer that question, there are some people that believe that. I think J.L. Collins wrote a Simple Path to Wealth, a book that you can get away with having a portfolio that is, you know, a total market or a U.S. market and a bond aggregation fund, and that's it. But a lot of people, what they'll typically do is they'll go a little bit more granular than that. So, you know, they'll say, okay, if, you know, just rules of thumb here, if I'm, you know, in an 80% equity portfolio, 20% bond portfolio, then I'll take that 80% and I'll divide it up amongst different positions. So a big part of that is going to be your domestic. So your large cap, mid cap, small cap. And you might say like, what are you talking about, Tim? What's large cap? So a large cap fund, you know, we're talking about market capitalization. This is calculated by multiplying the price of like the stock by its number of outstanding shares.
Mm-hmm.
So if a company has 20 million shares and the stock is selling at $50 a share, then the market cap is 1 billion, and that would put it in the small cap fund. So large caps are typically the companies, Tim, that we know about: Microsoft, Apple, those types of companies. You know, so there's typically they're safer as equities go, not as risky, you know, because they're grown, they're matured, you know, they're potentially paying dividends, that type of thing. Mid cap, a little bit less known, but still big, maybe a little bit more risky. And small cap, again, still very big companies. 300 million to 2 billion is typically what a small cap is. Mid cap is typically 2 billion to 10 billion, and large cap is 10 billion plus. So very, very large companies, but that for a lot of investors is going to make up the lion's share of the equity, that 80% in this example. Mm-hmm. And then you typically, you know, some investors will go into like international. So these are invested in companies outside of your country, you know, so for us it would be anything outside of the United States. And then it could be a little bit in emerging markets. These are, you know, invested in markets of like a developing country. So that might be like Eastern Europe or Africa. So that might be part of the 80%. And then for some people, you know, for some investors, they'll look at things like a real estate fund, like a REIT, or commodities, or maybe they'll even go into like more like sector type funds of like, you know, biopharmaceuticals or something like that. And it kind of is kind of what your belief is and what your interest is in that regard. That other 20%, Tim, you know, the 20%, the fixed income or the bond, it can be really used in a variety of ways. So a lot of people will do like a bond aggregation fund, but they could get more granular. So they could have like a government, you know, fund or a corporate bond fund. You know, there could be, you know, bond funds outside of the United States or short-term, long-duration bond funds, or even junk bonds, high-grade, low-grade bonds. There could be bonds that are associated with keeping pace with inflation, so TIPS. So it can get very confusing. And to answer your question, Tyler, there is no, I think right or wrong answer. I think we have a belief at YFP planning on how we, approach a portfolio. But I think that you can make a very strong argument that using a portfolio or two or even three securities, it can be well diversified, if you're in the right type of fund. So to me, some people, will look at, large cap and small cap and all that stuff. And they're like, hey, we trust you, Tim, whatever. Some people are like, I just want to keep it simple. Some people, sometimes we come across people and they have dozens of positions and we're like, what the heck is going on here? And trying to like parse through and see, what is the direction. And it can be a little bit, confusing to keep track of all that. So again, it depends really the answer to the question, but I think ultimately the question that you have to answer that I think is probably more important is, what is the breakdown for you, Tyler, in terms of an equity to fixed income, and then go from there.
Yeah, and Tim, as you were throwing around a lot of good investing terminology, you dropped a lot of wisdom in a short period of time. You're talking about asset allocation, equities, bonds, fixed income, capitalization, small cap, mid cap, large cap. I would point to Jeff Keimer wrote a great series. So Jeff Keimer wrote the book Fire RX that we published, but he wrote a great 2-part blog series, Crash Course in 401k retirement planning, part 1, part 2. We'll link to that in the show notes. But a lot of this terminology, I think, defined and might be a good place for folks to dive a little bit deeper. Tim, I would agree. Whenever I talk about investing, this is probably the most common question that I get, especially among folks that are early on in their investing journey, which is like, okay, I'm following the need to invest. I understand time value of money. I understand compound interest and growth, but like, I just don't know where to get started, right? In terms of that asset allocation, which second to that, then often comes a question of like, should I just put in a target date fund, right? And, I know that's a question that you get a lot. I'm sure the planning team deals with, like, just high level, separate topic for a separate day, but like brief definition of target date funds and what value and even perhaps some of the downsides that those might have.
Yeah, that's great question, Tim. So like often, when we speak to prospective clients of YFP planning, and one of the things is like, hey, I'm confused how to invest for my future. Everyone says like there's retirement, and I see this number that pops up on the screen when I log in, and it says like I'm on track or off. I have no idea. So like when we kind of break that question down, I'll ask the question like, hey, like how is your 401k? Like how is it invested? And just to kind of get a sense of like where they're at, and most of the time it's like I have no idea. It was so sometimes I'll lead the question. I'll say like, do you know how it's invested? Did you select any investments, or was it in like a kind of a default target date fund? And they're like, yeah, that's the one, the default, because I didn't sure as heck didn't pick it, which is a lot of our clients, and that's cool. So the default target date. So one of the nice things that's happened with legislation, from my perspective, is that a lot of these retirement plans, 401ks, you have to opt out. So like if you don't do anything, so the 401k at YFP, if you don't do anything, it automatically enrolls you and it automatically contributes a certain percentage unless you go in there and don't do that. And that's really helped with people to start saving, because anytime that you have to opt into something versus opt out, and it's going to be whatever the default is. So typically the default investment selection is typically a target date fund. And all a target date fund is it's a collection of stocks and bonds with the goal of meeting the needs, but it's the goal of providing the best possible return with the least amount of risk at a certain year or time in the future. So for a lot of clients, it could be a 2035 target date fund, a 2055 target date fund. And the idea is that they're taking your age and they're saying, okay, right around your retirement age, let's use 65. This is going to be where the fund is going to be most like safety in principle. So right now, if you're going to retire in 2055, it's going to be mostly stocks and equities because they're the most risky, but they typically have the most upside. If it's a 2025 fund, then there's probably going to be a lot more bonds because you want less of the roller coaster that we're seeing in the market and more safety in principle, more of those fixed income payments that a US bond or a corporate bond will pay. So target date funds are great, especially if you don't really want to have the hand on the wheel. but they're typically a little bit more expensive. And, one of the things we always talk about is that one of the main drivers of your portfolio is the expense associated with your investment portfolio. So, when we are looking at clients, we're often looking at those target date funds in their 401k, 403b, and then we're trying to find a better solution outside of the target date fund, because we can set that up and manage it and save a few bucks over the years that they're accumulating their wealth. So it's a great thing if it's like, hey, I'm doing it myself. I don't really want to look at it ever, because over time the fund itself will naturally become less aggressive and more safety safety in principle as you approach that date. But you pay a premium for that, and if you're working with a professional, that to me is something that they can step in and help. Not always, that doesn't always happen, but for us at YFP Planning, that's how we roll.
Tyler, great question again. Tim, great insights as well. And for folks that are listening, if you're feeling like, hey, I'm confused with how to best save for the future, or I'm making a great income, but maybe I'm not progressing as quickly as I would like to in this part of my financial plan, or hey, investing, it's one part, but I also got other competing priorities that are tugging at my money each and every month, whether that's student loans, whether that's, other expenses, saving for kids' college and so forth. So the team at YFP Planning, we'd love to have a chance to talk with you to see if our financial planning services are a good fit for you. You can book a free discovery call at yfpplanning.com. Thanks again for listening to this week's episode of the Ask a YFP CFP segment of the Your Financial Pharmacist podcast. If we feature your question on the show, we'll send you a super comfy YFP t-shirt. You can submit your question by sending an email to info@yourfinancialpharmacist.com, or you can record your question by visiting yourfinancialpharmacist.com/ask-YFP. If you don't feel comfortable sharing your name on the show, you can send or record your question anonymously. As we conclude this week's Ask a YFP CFP episode, an important reminder that the content in this podcast is provided to you for your informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on this show. Opinions and analyses expressed herein are solely those of Your Financial Pharmacist, unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you for your support of the podcast and have a great rest of your week.